Last week's aspirational orders didn't fill, but hey, you can't blame me for trying. This week, NVIDIA's share price climbed, so I rolled my covered call up from 180 to 182.50. The premium on that roll was low because I prioritized raising the strike to lock in the chance at about $250 in potential capital gains, and to set up a stronger roll next time if the share price keeps rising. I let last week's $160 cash secured put expire worthless and sold a new one at $175 for next week. That means we're still running both sides of the double Ferris wheel, with the put side bringing in a solid premium and the call positioned for possible upside in the shares. Let's walk through the trades, the numbers, and the possible outcomes from here. The $160 put is about to expire out of the money today, but the $180 call is in the money by $2.47. I'm going to roll both positions out 1 week, and I'm going to see if I can increase the strike price of the covered call and still generate a net credit. A straight roll, keeping the strike at 180, will generate $2.04 or $2.08 per share credit. I can increase the strike price to 182.50, generate about $50, and increase my capital gains by $2.50 if the contract is assigned. I'm going to roll this position up for a little bit of premium and an additional $2.50 per share or $250 of potential capital gains. It filled at $60. Now let's roll the cash secured put. Keeping the same strike price of $160, I would only bring in $14 or $15. If I increase it to $170, I can bring in $38. And if I go up to $175, I can generate $83 or $84 with a less than 20% chance that the contract will be assigned next week. I'm going to attempt to roll the cash secured put up to $175, expiring next week. And if I can't get the order to fill, I will just leave the $160 put to expire at the end of the day today and sell a $175 strike put expiring in 7 days. Setting the order up as a roll does not seem to be working, so I'm going to cancel that order, leave the $160 put to expire, and just sell a new put outright. The put filled at $85. Now let's put everything on the spreadsheet. The new collateral requirement for the cash secured put is $175, and for a 7-day holding period, the premium of $84.34 creates an annualized rate of return of 25.13%. For the collateral value of the covered call, I'm going to use the number 180 because that's the amount of cash that I would bring in if I allowed this contract to be assigned today. So rolling it instead brings me a 17% annualized return for a 1-week contract, as well as an additional potential $250 of capital gains. I color the line with the cash secured put green and the covered call blue. Rolling the covered call closed this position, and this covered call will expire at the end of the day in a couple of hours, so I'm not going to change the color on my spreadsheet until that actually happens. I'm going to remove these two lines because I had placed aspirational hopeful orders just in case the share price moved in certain ways, and neither one of those automatically filled during the week. So a quick sum of the total expense and income. I bought 150 shares, sold a call, sold a cash secured put, sold another cash secured put expiring 1 week later, and rolled the covered call. So I'm now out of pocket $25,692.30. divided by 150 shares is an average investment of per share of $171.28. The net liquidating value of the entire position, $27,004. So my current position is worth $1,311 more than I have invested in it in the last 7 days. Of course, some of this profit is realized and some of it is unrealized, but if I wanted to liquidate everything right now, I could lock in a $1,311 profit. So I'll see you next week on August 15th, and we'll see how this plays out.